In this video, I'm going to talk about depreciation. Depreciation is an adjusting entry. Adjusting entries are done at the end of the accounting cycle to record revenues in the period earned, expenses in the period incurred, and update asset and liability accounts. And end of the accounting cycle is usually year end. However, some companies do adjusting entries every month. The types of adjusting entries that I've already talked about are deferrals and accruals, so be sure to go back and watch those other videos. The last adjusting entry I'm going to talk about is depreciation, and then in the next video I'll do some worksheets where we go through several examples. Okay, let's talk about what depreciation is. Depreciation is allocating a plant asset's cost to expense over its useful life. A plant asset is simply an asset that's going to be in the business for a long time. So things like buildings, equipment, furniture, vehicles, those are considered plant assets. The asset would be recorded at its cost in an asset account. And due to something called the historical cost principle, it would stay on the books at that cost until it's sold or disposed of. So once you put the asset on the books, you're not changing that amount. You're not expensing the asset itself. And then useful life, that's the expected life of the asset. And this could be stated in years or in months or some other time period. A plant asset, if you look up the definition, you're going to see something like this. It's a real or tangible, long-lived asset. Long-lived meaning you're using it in the business, something that's going to last a year or more, typically. Things like buildings, vehicles, furniture and fixtures, equipment, machinery. Land is considered an asset, but it's not depreciated. However, you can depreciate something called land improvements, which would be fences, sprinkler systems, signs, and other improvements. And I'll talk about this more when we go more in depth about depreciation at a much later point. Some of the accounts that are used in depreciation would be, first of all, you have the asset account where you record the asset purchase at cost. And then you would have the depreciation expense account to record the yearly or monthly depreciation expense. And then the accumulated depreciation would also be something that you would record. And accumulated depreciation is considered a contra asset account. In other words, it's the opposite of the asset. The asset has a debit balance. The contra asset has a credit balance. It's a normal credit balance. And it's the cumulative sum of all the depreciation that has been recorded on a particular asset. In other words, the balance is just going to keep getting bigger until the asset is fully depreciated. And then once it's fully depreciated, you would stop recording depreciation expense and stop recording accumulated depreciation. And this is what the actual adjusting entry would look like. It would be a debit to add to depreciation expense. Expenses go on your profit and loss or your income statement. And then it would be a credit to add to accumulated depreciation. This is that cumulative sum that's going to keep getting bigger until the asset is fully depreciated. And we're going to talk about some different ways to calculate the amount. I'm going to give you the simple way in this video, and then later on we'll talk about more methods. And this is done at year end. However, some businesses will break it down into a monthly amount. So if it's $12,000 a year, they might break that down into $1,000 per month. So it just depends on the company. Different companies do it differently. And then from a T account standpoint, this is what the accounts would look like. You have the asset account where purchases would be on the debit side. And then when those assets are disposed of, in other words, sold, or maybe they get rid of them because they're worthless, whatever the case may be, once they dispose of that asset, it would be a credit to subtract. So you're adding purchases on the debit side, subtracting on the credit side. And then you would have depreciation expense, which is your debit in the adjusting entry, and accumulated depreciation would be the credit in the adjusting entry. You're adding to expenses with a debit and adding to the contra asset with a credit. So this is going to be the opposite rule of the related asset. Okay, this depreciation expense would be reported on the yearly income statement. And later on in a later lesson, we're going to talk about accounts that get closed out at year end because they're related to that specific year. And after the year is over, it gets closed out. So your expense on the income statement for the year is going to represent the depreciation for that year. And then accumulated depreciation would be on the balance sheet. And this balance is going to get bigger and bigger because balance sheet accounts tend to carry forward from year to year. And we'll talk about all of this at a later point. For now, just know that this balance is going to get bigger and bigger until it's fully depreciated. In other words, you're not going to depreciate beyond the cost of the asset. If you have an asset that's $12,000, you can't depreciate more than $12,000 of expense. The entire depreciation process is simply taking this purchase price or this cost and expensing it and showing it as an expense as you use it up over time. Well, you can't use up more than you purchased, so you stop depreciating once it's fully depreciated, once you get to the total amount. And then this is what the balance sheet would look like for that asset. You would have the cost or the purchase price of the asset. In this case, I'm using an example of equipment that was purchased for $15,000. You would subtract everything in that accumulated depreciation account. So if at this point the company had depreciated at $2,500 total over time, then that would be the amount that would go here. And it's a contra, meaning that it's subtracting, it's opposite. So you're taking the cost minus the depreciation amount, the accumulated depreciation amount, and the difference is going to be your book value. Book value is simply cost minus accumulated depreciation. If you look up the definition of book value, you're probably going to get a lot of different things, but this is all it is. It's basically representing the cost that has been invested in the asset, but it hasn't been depreciated yet. In other words, out of this $15,000 cost, they've depreciated $2,500, so $12,500 is the amount that they haven't depreciated yet. And the $12,500 doesn't represent the market value. They could sell this equipment right now for $20,000, or they could sell it for $8,000. It doesn't represent the market value, it represents the book value, the value on the books. If they were to sell this asset right now, the sales price minus the book value would be the gain or loss of the sale of the asset. So if they sold this for $20,000 minus the book value of $12,500, they would have a $7,500 gain on that sale of the asset. And they would have to report that gain and more than likely pay tax on it. Or if they lost money, if they sold it for $8,000, $8,000 minus $12,500 is a negative $4,500. They would have a $4,500 loss that they would report. So that's how it would work. That's what the book value is. And this is how it would look on the balance sheet, which later on we'll go through some detailed balance sheets and look at it more thoroughly. At this point, just understand these basic concepts. And then to calculate the amount of the depreciation, there's a lot of different methods. Straight line depreciation is usually the first method that you learn because it's simple. It expenses depreciation evenly over the asset's useful life. And you use a formula. You're going to take the asset cost minus something called salvage value and divide it by the useful life. Salvage value is also called residual value. It's the estimated value at the end of the asset's useful life. And then useful life is the expected life of the asset, usually in years. Sometimes you can calculate this per month. I'm going to go through an example with this formula. On January 1st, the business purchased equipment for $10,000 with a salvage value of $2,000 and a useful life of 8 years. So you would plug that into the formula. $10,000 minus $2,000 divided by 8 is equal to $1,000 per year. And you would plug that into your adjusting entry. Debit depreciation expense. A lot of times they'll have separate depreciation accounts for separate types of assets. It just depends on the company. But they would have depreciation expense dash equipment for $1,000 and a credit to accumulated depreciation dash equipment for $1,000. And they would do this every year for 8 years. Once they got to the end of the 8 years, they would stop depreciating this asset. It doesn't mean they can't still use the equipment, but they simply wouldn't be depreciating it anymore because the balance of accumulated depreciation would reach the $8,000. And they don't want to depreciate the entire $10,000 if they set a residual value of $2,000. You're only going to depreciate up to the amount of the cost minus residual or salvage value. And we'll do more examples in another video. This was just to introduce the topic and get you familiar with some of the terminology, some of the entries. And in the next video, we'll do several examples for all the adjusting entries. I might do a few videos. It just depends on what I come up with. But I hope this was helpful. If you have any questions, feel free to comment below, and I'll see you in the next lesson.